He was called the boy plunger, a man who could move markets with a single trade, revered, feared, and ultimately consumed by the very game he mastered. This is the story of Jesse Livermore, the most legendary trader in Wall Street history. Jesse Livermore was born on July 26, 1877, in Shrewsbury, Massachusetts. His father, a struggling farmer, wanted Jesse to work the fields, but Jesse had different ambitions. At the age of 14, with the encouragement of his mother, he ran away from home with just $5 in his pocket and took a job as a quote boy at Paine-Webber in Boston. That decision would mark the beginning of one of the most remarkable trading careers in history. As a quote boy, Jesse transcribed stock prices from ticker tapes and posted them on chalkboards. This seemingly mundane job gave him a front row seat to the heartbeat of the market. He began jotting down prices, studying how they moved, and identifying patterns. His observations convinced him that price action could reveal the psychology of the crowd, an insight that would shape his trading philosophy. At the age of 15, Livermore placed his first trade at a local bucket shop, a venue where traders speculated on stock price movements without executing real trades on an exchange. He made $3 profit on that trade and never looked back. By the age of 20, he had turned his winnings into thousands of dollars and had already experienced the roller coaster of early fortune and financial loss. Bucket shops became Livermore's training ground. His ability to predict price movements earned him the nickname the boy plunger because of his willingness to make aggressive bets. But his success became a liability. Bucket shops feared him. Many refused to accept his trades, claiming he was manipulating the odds. In response, Livermore moved to New York City. There, he entered the world of legitimate trading at the New York Stock Exchange. But Wall Street was a different beast. Unlike the controlled environment of bucket shops, real stock trading required navigating complex market dynamics, liquidity constraints, large capital requirements, and manipulative practices by other traders and insiders. Livermore faced harsh lessons in his early days on Wall Street. He lost most of his capital several times. In one instance, he lost $50,000 in a single week, a colossal sum at the time. But each failure taught him something new. He began keeping detailed notebooks on every trade, what he did, why he did it, and what went wrong. His big breakthrough came in 1907 during a market panic triggered by a credit crisis. Livermore sensed the fear and began shorting stocks. As prices collapsed, he made an estimated $3 million in a matter of days. His trades were so impactful that J.P. Morgan, the legendary banker, personally asked him to stop shorting to prevent further panic. Livermore agreed, believing that preserving the market was more important than profiting from its destruction. Despite this act of restraint, Livermore's career remained volatile. He went broke again in 1915, only to bounce back stronger. He fine-tuned his trading strategies, cut losses quickly, add to winning trades, and never trade on tips or hunches. One of his core principles was patience, waiting for the market to confirm his thesis before entering a position. He believed in sitting tight, resisting the temptation to overtrade. In 1929, Livermore cemented his place in history. Sensing another market bubble, he began shorting stocks heavily. When the market crashed in October, Livermore's position skyrocketed in value. He reportedly earned over $100 million, equivalent to more than $1.5 billion today. But public sentiment turned against him. Though he had merely profited from a market downturn, many blamed him for deepening the crisis. He became known as the Great Bear of Wall Street. Livermore's personal life was marked by tragedy and instability. He married 3 times and had strained relationships with his children. His second son, Jesse Jr., later wrote a memoir revealing the emotional toll that trading had on their family. Despite his immense wealth, Livermore was never at peace. He battled depression, particularly during periods of financial loss. His final years were marred by poor investments, failed business ventures, and a growing sense of isolation. On November 28, 1940, Jesse Livermore took his own life in a New York hotel. He left behind a note addressed to his wife. My dear Nina, can't help it. Things have been bad with me. I am tired of fighting, can't carry on any longer. His death shocked the financial world. But for many, Livermore's legacy was not his tragic end. It was the brilliance of his mind and the clarity of his trading philosophy. Key lessons from Livermore. Markets are governed by human emotion. Mastering yourself is more important than mastering the market. The market is never wrong. Your opinions can be: cut losses quickly and let profits run. Avoid the noise. Follow price, not news or rumors. Be patient. The best trades take time to develop. Jesse Livermore's life was immortalized in Edwin Lefebvre's classic book, Reminiscences of a Stock Operator. Though the book is a fictionalized account, it provides deep insight into Livermore's psyche, principles, and the timeless nature of speculation. His story serves as both an inspiration and a cautionary tale, a reminder that brilliance in trading does not guarantee peace in life. But above all, Livermore remains a symbol of what's possible when intuition, discipline, and boldness meet the chaotic rhythm of the markets. He's one of the most iconic names in hedge fund history, a man who predicted the 1987 stock market crash, managed billions, and built one of the most successful macro trading careers in modern finance. This is the story of Paul Tudor Jones, a trader who mastered timing, discipline, and the power of conviction. Paul Tudor Jones, too, was born on September 28, 1954, in Memphis, Tennessee. His father was the publisher of the Memphis Daily News and a lawyer, giving young Paul early exposure to business and economics. He graduated from the University of Virginia in 1976 with a degree in economics. While in college, Jones was a middleweight boxing champion, a discipline that would later influence his trading mindset. His trading career began as a clerk on the trading floor, but it didn't take long before his talent became apparent. He joined E.F. Hutton as a commodities broker and began to develop a reputation for being a fast, aggressive, and insightful trader. Still, he wanted more than just commissions. He wanted to bet big and bet right. In 1980, he founded Tudor Investment Corporation with just $30,000. Within a few years, he had turned it into a powerhouse hedge fund. Jones focused on macro trading, identifying major economic trends and placing large directional bets on currencies, commodities, bonds, and equities. His greatest moment came in 1987. Jones predicted that the stock market was headed for a massive crash. Using a combination of technical analysis, market history, and intuition, he began building short positions. On October 19, 1987, Black Monday, the Dow Jones Industrial average dropped 22% in a single day. While most investors were blindsided, Paul Tudor Jones made a 200% return that year. Jones was also an innovator. He incorporated behavioral finance into his trading strategy long before it became fashionable. He believed markets are driven by human emotion, herd behavior, and psychological extremes. Beyond trading, Paul Tudor Jones is known for his philanthropy. He founded the Robin Hood Foundation, one of the most impactful anti-poverty charities in the U.S. He also focused on education and community development, investing both his money and time into causes he believed in. Like many legendary traders, Jones emphasizes discipline, adaptability, and humility. He openly admits when he's wrong and cuts his losses quickly. He's a firm believer in listening to the market, not trying to outsmart it. Jones' legacy is one of consistency, intelligence, and resilience. In a world where many traders burn out after a few years, he has remained relevant and profitable for decades. Key lessons from Paul Tudor Jones. The most important rule of trading: don't lose money. Always play defense before offense. The market often behaves irrationally. Use that to your advantage. Risk management isn't a strategy. It's the foundation of survival. Stay humble. The market doesn't care who you are. Paul Tudor Jones remains one of the greatest traders of all time, not just for his wins, but for the mindset and philosophy that allowed him to thrive in any market condition. His story is one of vision, courage, and long-term excellence in the unpredictable world of trading. George Soros, the man who broke the Bank of England. George Soros, one of the world's most successful investors, is a man whose career has been marked by risk, controversy, and unparalleled financial acumen. Born in Hungary in 1930, Soros rose from humble beginnings to become a billionaire, famous for his prediction of the 1992 Black Wednesday crisis that made him a legendary figure in the world of finance. But what sets Soros apart from other traders isn't just his wealth, it's his deep philosophical approach to markets and the human psyche that continues to shape his investment strategies. Early life and career. George Soros was born György Shorts in Budapest, Hungary, to a Jewish family. Growing up during the Nazi occupation and surviving the horrors of World War II, Soros developed a resilience that would shape his future. He later changed his last name to Soros, meaning to soar in Hungarian, symbolizing his aspirations for the future. After the war, Soros moved to London and attended the London School of Economics, where he studied philosophy under the guidance of Karl Popper, an influential philosopher of science. Popper's ideas, particularly his concept of open society and his theory of falsifiability, had a profound impact on Soros' worldview. Soros took Popper's philosophy of critical thinking and applied it to the markets, believing that financial markets, like scientific theories, are subject to change and uncertainty. The journey to Wall Street. Soros' first job in finance was at a merchant bank in London, and after gaining experience, he moved to New York in 1956 to work at various financial firms, including F. Meyer, where he honed his trading skills. In 1970, he launched his own hedge fund, the Soros Fund Management, which would later become one of the most successful investment firms in. Soros' strategy was simple yet revolutionary. He sought to understand and exploit the underlying psychological forces driving the market, believing that markets were not efficient, but instead deeply affected by the biases and emotions of investors. The Black Wednesday trade. Soros' most famous trade, and arguably one of the greatest trades in history, occurred on September 16, 1992, when he broke the Bank of England. The British government had been maintaining the pound at an artificially high value within the European exchange rate mechanism, despite the fact that the British economy was weakening. Soros recognized that the pound was overvalued and that the British government would eventually be forced to devalue it. He made a massive bet against the pound, shorting over $10 billion worth of the currency. When the British government was unable to defend the pound and was forced to withdraw from the ERM, the pound collapsed and Soros made an estimated $1 billion in profits from that single trade. This event solidified Soros' reputation as one of the most successful and daring traders in the world, earning him the title, the man who broke the Bank of England. The theory of reflexivity. One of Soros' most significant contributions to the field of investing is his theory of reflexivity. Soros proposed that market participants' perceptions of reality, whether true or false, can influence the economic fundamentals they are trying to interpret. In other words, the feedback loop between perception and reality can create self-reinforcing trends, leading to market bubbles and crashes. This theory challenged the traditional notion of market efficiency, which assumed that markets always reflected the true value of assets. Soros' view is that markets are often driven by subjective perceptions and that understanding the psychology of market participants is just as important as analyzing the underlying economic data. The Open Society Foundations. While Soros is best known for his trading acumen, he is also a philanthropist with a deep commitment to promoting democracy, human rights, and open societies. In 1993, he founded the Open Society Foundations, a network of organizations dedicated to advancing social justice, education, public health, and human rights around the world. Through OSF, Soros has donated billions of dollars to causes ranging from the promotion of democracy in Eastern Europe to the fight for drug policy reform in the U.S. Soros' political and philanthropic activities have often drawn criticism. His support for progressive causes and his backing of political candidates and movements have made him a target for conspiracy theories. Despite the criticism, Soros remains steadfast in his belief that open societies, characterized by freedom of expression, rule of law, and tolerance, are crucial to solving the world's most pressing issues: trading philosophy, risk, and uncertainty. Soros's approach to trading is rooted in a deep understanding of risk and uncertainty. He often says that the key to successful investing is not predicting the future with certainty, but understanding that the future is inherently uncertain. For Soros, the ability to embrace uncertainty and adapt to changing circumstances is the hallmark of a great investor. His risk management philosophy is centered around the concept of cutting losses quickly and letting profits run. Soros is known for being highly disciplined when it comes to managing risk. If a trade doesn't go as planned, he cuts his losses swiftly. This approach has allowed him to protect his capital during adverse market conditions and capitalize on the rare but lucrative opportunities when they arise. The Quantum Fund and Legacy. Soros's hedge fund, the Quantum Fund, achieved an annualized return of over 30% for nearly 3 decades. His success as an investor was driven by his ability to identify major macroeconomic trends, understand the psychology of market participants, and then take bold positions in the market. Soros's legacy is not just about his financial success, but also about the impact he has had on the world. He has changed the way we think about markets and risk, and his philanthropic efforts have helped promote democracy and human rights globally. Key lessons from George Soros. Markets are driven by perception and psychology, not just fundamentals. Understanding the biases and emotions of market participants is crucial. Risk is an integral part of investing. Embrace uncertainty and be prepared to adjust your strategy as conditions change. Cut losses quickly and let profits run. Risk management is as important as finding the right opportunities. Believe in the power of open societies. Soros's commitment to social justice and democratic values has had a lasting impact beyond finance.